This is one of those podcast episodes you're not going to want to miss. We're going to talk about Jamie Dimon, Warren Buffett, a Ponzi scheme, and Trump. How does all this relate to real estate and commercial real estate?
It is February 28th. Is this the last day of the month?
Yeah. No, it's a leap year.
So it's 29?
29.
Oh, sweet.
Comes around every 4 years, 5 years?
Oh, there you go. Podcast number 52, the Anton Stentner podcast. We're going to be talking about commercial real estate today.
I love it. I love it.
And it's hopeful, right? A lot of positivity, a lot of great things happening.
It's hopeful, but we're going to scare you towards the latter part of this and ask some tough questions.
Yeah, I mean, obviously I was kind of joking around, but Jamie Dimon believes that commercial real estate crisis can be averted by a soft landing. So I guess that is a little hopeful.
This is a little hopeful.
Okay.
And so Jamie Dimon just had a conference, and so they were speaking to him at the conference, but you can hear him kind of changing his tune. He is the CEO of Chase, so the largest bank around. And he said the market is pricing in for a soft landing, but he believes the odds of a soft landing are lower than what the market expects. He said, however, he believes this soft landing is starting to look good for commercial real estate. He also went through and then said, commercial real estate is not, this is what like all of a sudden my spidey sense was really paying attention. Commercial real estate will not be the source of the next credit event. Consumers remember vividly 2007, 8, and 9, but this situation's not the same. He then went on to say basically that there's this idea that there's a domino effect and that's overblown in the commercial real estate sector because this minor surge in defaults, this change in prices is simply a regression to the mean. And what that means is it's just returning to normal, okay? But by doing that, he's really going against his kind of billionaire friends and peers and kind of bucking that trend because most of them are out there saying or telling him this market's going to get ugly. So it was interesting to hear Jamie, come out at his conference and say this. He said commercial values are being affected by low interest rates. They had low interest rates and interest rates have risen, so that rise in the cost of capital is making commercial real estate a less viable option. But he believes that most of these people will be able to manage through the problems, refinance, add equity, or sell the properties. And this is also what's interesting. So remember, he runs Chase. He says the regional banks are not a specific indicator of a broader problem, and the risk to commercial real estate will depend on each circumstance in each bank. So the biggest boy on the market doesn't care that the little boys are having problems and that they may not be able to come and play the baseball game.
That's what I was going to ask you. Like, is there another motive to this stuff, right? It's like you have to always take it with a grain of salt, what he's saying, because he has a duty to Chase Bank, not necessarily to the banking industry, even though, of course, the health of the industry is going to affect him good or bad. But I was going to go there. And I mean, what's your thought?
They've said the big five cannot gobble up anyone else because they're too big, unless a special circumstance arises. Well, a special circumstance arose during Silicon Valley Bank, and they got parted out to the big boys. So then he went on to say, basically, this is not a systemic problem. So once again, he's doing something for himself and his shareholders. And he goes, this is not a whole banking problem. It's just the little guys over there that, sooner or later we might buy out. One thing that he alluded to that really rang true in my heart was that one of these things that's keeping inflation higher for longer as the Fed battles inflation is government spending. The government is still spending like a bunch of drunken sailors. They're spending more than they're collecting in tax revenue. So then what's happening is this is artificially propping up the economy, artificially propping up real estate, commercial real estate. And the catch to all of this, he says, is if rates or inflation doesn't get under control and rates remain high, this could get really ugly. So we're going to keep watching this like we always do. And then also towards the end of all of this, we're going to come at this with a much more opposite opinion of like the sky is falling, because for our investors, for our listeners, what we're always trying to do is we're trying to cover the pros and the cons. We want to look at all sides of the situation. We want to go into it eyes wide open, because I'm a slightly optimistic person, but that doesn't mean you want to be a perma bull. And it also means you don't want to be a perma bear. So we got to look at both sides consistently as we continue to analyze.
That's just smart to do anytime, because even we've talked about this in the past, the experts actually don't know what's going to happen. There's just too many variables. And wouldn't it be the same for him? And also, you have to take everything he says with a grain of salt, because he's so influential. If he says something bad, it could tip the scale.
Bingo.
You know, he could literally influence people and investors especially to sell arbitrarily or artificially based off of him saying, hey, everything's going to shit. We need to sell everything. And, and then literally a run on the bank.
He is well known enough and such a strong force in the banking sector, he can move the economy based on his words. So he does have to be very careful. And so as you're listening to him speak, you have to read between the lines. You have to go watch multiple of his speeches in a row. You have to look at what Chase is actually doing in the background. And, so when you look at all that, you go, commercial real estate probably isn't that bad, but he's also setting himself and the bank up for opportunity.
Yeah, for sure. And so I guess what's the biggest takeaway from what you heard from what he said at that conference? The
biggest takeaway there is that we're going to go back to what we talked about before. We need to be cautiously optimistic. We need to pay attention to the Federal Reserve and where interest rates are going. And we are very, very long-term bullish. And this is another thing we're going to get into later on. But short-term pain. And short-term pain creates massive opportunity.
Okay, so let's talk about the other billionaire, Warren Buffett. What's he saying?
So Warren Buffett, during the last recession, he talked about this metric that was a bad number that kind of indicates how it could be a good indicator for future real estate. So it's kind of like counterintuitive. And so at the 2010 Berkshire Hathaway annual shareholder meeting, he revealed one of his approaches to analyzing the real estate market health. And what he talked about was, he said, hey, I need you to think about this as a paradox, that decreasing housing starts is a signal of a healthier housing economy ahead. So when you look at that, you say, wait a second, a negative number means future goodness. Why? What happens is you could have the bad number for a while. In this case, lower housing starts. And housing starts, how the federal government defines that, a housing start is when they start to build a single family home or an apartment or a townhome.
Not when they're going for permitting?
That is a housing start. No, they run permitting as a whole separate metric.
Okay, got it.
This data is available right on the Federal Reserve. So like I said, I geeked out getting ready for this one. And what they were talking about during the Great Financial Recession, or the Great Financial Crisis, which was the Great Recession, was that as housing starts dropped, what it was doing was it was cleaning up that excess demand that was available. So this is kind of, once again, that counterintuitive wisdom, and that's for 2008 thinking. Now let's move into today and think about how this looks today. So nationally and locally, we know the Seattle Metro, we're behind on housing. We know nationally, we are behind on housing. And so what I want to do is I want to dig into these national numbers first. And once again, you can get this right off of the St. Louis Federal Reserve. And if you look at this graphic, each one of these gray bars that's on here, you'll be able to see those are recessions, okay? And then this is recorded on a monthly basis, and they report the housing starts. So you can see in the early 90s and the 2001 recession, housing starts dropped. You can then see housing starts essentially rips all the way to 2006. Once again, this is nationally. In January of 2006, housing starts peaked at 2,273,000 units. We were actually overbuilding the nation because of the things we've talked about before. The ninja loans, the buyer didn't have to qualify, and also the builder and developer didn't have to qualify as hard. They didn't have to have 25% cash into it, and they could finance at 100% LTV. So that caused this overbuilding of the United States. The Great Recession happens, or the Great Financial Crisis, or the Big Short, however you want to look at it. Housing units drop all the way to 478,000 in April of 2009. 478 versus 2.2, almost 2.3 million. That's 21% of the houses were built in April of 2009 versus the peak. Massive decline. That drop right there is what the renter is feeling today when they say my rent is going up. It's what the homeowner says when they say, I want to buy my first time home and it's unaffordable. Is this gigantic hole in 2000, basically the latter part of 7, 8, 9, 10, 11, 12, 13, 14, and the beginning of 15 and 16.
Are you saying that during that period of the Great Recession, rents went so far down that the contrast from that 2008, 10, 12 period to now is what's causing this feeling of it's too expensive?
Really close. What I'm saying is the construction of new units dropped by so much that what it did was, because we still made babies and people still moved here. So population went up while we constructed essentially 79% less units. So the overall supply constricted by almost 80%. So then a decade later, that problem massively shows up and we go, holy cow, home prices are rising rapidly. Rents are rising rapidly.
So why does Warren Buffett say this is good for the housing market?
Well, let's talk about that right here. So all of a sudden we have COVID, okay? They lower interest rates. Housing starts keep climbing. Housing starts peak in April of 2022 at basically 1.8 million units after the Fed raised 550 basis points or 5.5%. Notice how the peak of 1.8 was not back near the original peak in 2006 of roughly 2.3. Then, because debt was so much more expensive, we started building less homes. In January 2004, we only did 1.3. Now, generally is always lower, but that's 30% less than the peak in 2022, which was already below 2006 peak. So what Warren Buffett did was he looked at this, and as usual, my main man Warren Buffett's totally right. He goes, housing starts are going down. That means we're going to have a less supply coming in the future. Demand will find the floor, and when demand finds the floor, housing starts will slowly come up, which will cause prices to rise artificially.
So he stated the obvious. High demand, a low supply means the market will capitalize on the opportunity, making more houses.
Well, he also went on and made $1 billion bet in regards to that.
Oh, I didn't know that.
Yes. So,
okay.
So we'll get there in 2 seconds, but he put $1 billion of his own money into this bet. So if Big Daddy Warren's going, I'm going to bet on the housing market. That's why I said we're short-term cautious, a little bit conservative. We're looking for deals. We're looking for opportunity, but we're extreme long-term bullish right now is because of things like this. Now we dig into Seattle, or excuse me, Washington State. Washington State, we reflected almost the exact same graph that you saw nationally. You can see the early 90s and in the 2001 recession, housing starts dropped. You can see we peaked earlier though. So in November of 2005, we peaked at 5,788 units being built that month, where we overbuilt locally here in Washington. Then we have the Great Financial Crisis or the Great Recession. We bottom at 1,063 units in February of 2009, 18.4% of the peak. So in other words, we built even less in the Seattle metro and in Washington State than they did nationally in the Great Recession. We are in more of a problem here locally. Long-term bullish. The Fed raises rates. Right before the Fed raises rates, we peak at 5,505 units in August of 2021. The Fed then raises rates 550 basis points or 5.5% to cool the inflation they created. Then in December of this year, because January's data is not out for the state of Washington, it was 2,670 units, 51.5% lower than our peak in August of 2021. So wait a second. Were prices going up in 2021?
Yes.
In 2020?
2020 went down and then went back up.
2022 went down.
Okay.
2020 was still going up.
Yeah, it was going up. Yeah. You're going backwards here.
I'm going backwards.
Yeah. But yes, it was going up.
That's my point. We're building even less homes now in Washington State than we were in 2021, 22.
Crazy. So you're just saying
I'm saying as an
There- it's-
investor, you need to buy something because you're going to get above average appreciation. As a home buyer, you need to not wait.
Oh, crazy.
Because
That's
look at the graph. I mean, look how much it drops right there.
wow. That's kind of crazy because we've talked about low inventory is forcing lots of competition, right?
Yes.
High interest rates maybe slow people down from coming in, but right when it ticks down, we've already seen activity really pump up and house prices have nowhere to go except up. But now you're seeing data
Yes.
based off of home starts and like, are we going to give him a nickname? Big Papa Buffett? Big Papa Buffett is betting $1 billion on it. Basically, what he's doing is like, this is a sure thing that it's about to happen.
The Oracle of Omaha only makes bets when he can make long-term, slow, steady winners. He bets long-term. He doesn't bet on minor trends. He bets on really big trends.
So the takeaway is if you're thinking about buying houses, but you're on the fence for whatever reason, and one of those reasons is you are hoping for house prices going down, highly likely that's not going to happen. Much more likely that house price is going to go up from here and the best deals might be now.
The best deals will be now and most likely over the next 6 to 9 months because you have to think about how land development and housing starts work. If I started a home today, it would be finished and sold somewhere between 7 to 12 months from now. So let's call it 9. So if housing starts are at a low now, that shows up 9 months from now. And as builders see demand pick up and as interest rates go down, they'll start to bring more inventory, but they won't be able to bring it fast enough because of regulation and things of that nature. So it means 25 and 26 should have above average appreciation on the rent side and on the price side. It's crazy. So here's what Warren Buffett did. So in August of 2023, he takes Berkshire Hathaway, that's his main company. With his faith in the housing market, he acquired massive shares in D.R. Horton, NVR, and Lennar with a $800 million combined investment. Why? Because he did the same thing he did in 2010. He looked back and he said, housing starts are looking kind of low again. We should make another bet because, you know, the United States and Washington State, Seattle Metro, they're all going to run out of inventory. So Warren Buffett's like, we'll go bet $1 billion. What's $1 billion between friends?
And the takeaway being, if he's betting that big, you should not necessarily bet big, but better believe it that it's in your best interests to really start looking, if not start buying real estate right now.
I think if you can buy deals that make sense today with the high interest rates, as interest rates go down and rents go up, you will be unnaturally rewarded in 25, 26. Their cap rates are higher too. You know, we've talked about this with multifamily. But because those cap rates are higher and the debt's more expensive, we know the debt has to come down. The Fed's going to have to lower these interest rates, which means the future is just brighter. Just buy deals that make sense. Don't be dumb.
For sure. And speaking of dumb, let's talk about Ponzi schemes.
Number one, real estate falls apart when it's not based on hardcore fundamentals. And it falls apart when markets shift and transition. And that's how these Ponzi schemes pop out. So we're going to talk about this Ponzi scheme. And then at the end, we're going to talk about the moral and the lesson that investors need to hear from this story so they can be a better investor, so they can see the market, they can see the shyster for the fraud they are. So a former executive pled guilty to $658 million Ponzi scheme. His name is Thomas Nicholas Salzano. He's 65. He was the boss of the defunct New Jersey-based development firm, and he pled guilty to securities fraud and conspiracy charges in a $658 million Ponzi scheme that advertised, this is the key part, investors, hear this, market-beating investment returns, and that they were actually just barely profitable real estate ventures. This is what the prosecutors said. They said his role as the chief executive officer for National Realty Investment Advisors of Syracuse, New Jersey, U.S. Attorney General Selinger, said in a statement, he got him to plead guilty and a prison term of 8 to 12 years and pay $516 million in forfeitures and restitution. Here's what's funny. When people see these headlines, they're like, oh, these investors are going to get their money back. That's what they got charged with. The investors almost never get their money back. It's usually gone.
So where does that money go to?
That money will go to the investors, it'll go to the bank, but they have to extract it from the individual who stole the money, and the individual who steals the money generally spends it all.
Yeah.
Sam Bankman-Fried, prime example. Where'd all that investor money go? They partied it away. They bought yachts. They bought houses. These guys probably did something similar. So for years, Salzano told lies to investors to continuously deceive them and operate a Ponzi scheme through which he stole money from thousands of investors, Selinger said. His greed and flagrant disregard for the law caused a staggering loss. He defrauded over 2,000 investors in October alongside their president, and he concealed his true control of it. So the other guy, Garbato, is currently a fugitive. He's believed to be hiding in the Philippines. Okay, so he just ran away. He's like, I'm out. Leaves this guy holding the bag. But this is the part you got to really pay attention to. In TV ads and on the radio, it would say that NRIA was offering targeted returns of 21%. While in reality, NRIA generated little to no profits and was essentially operating a Ponzi scheme. So this is that tale as old as time, where greed got the best of both of them. The greed cost the investor money, and the greed created this Ponzi scheme. As an investor, when you go, oh man, all my friends are making money in crypto. They just made 1,000% return and Doge is going to the moon. When you hear something like that and then you turn around and go buy it, or they're promising a 21% return, internally, you should go, your spidey sense needs to say, this might be a problem. This might not be sustainable. That's why I said this is that tale as old as time. And the massive mistake that investors make is they let the FOMO kick in. Especially when we looked at that last crypto bull run cycle, FOMO kicked in. Everyone was just buying and buying and buying. I talked to one of my friends. He lost $765,000 as crypto rocketed. He was like, I'm making so much money. Bet, 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 bet. This Casino Royale, bet, bet. Crashes. Gone. At some point, if you need to have a check mechanism, a friend, a family member, whatever it may be, to target that greed. So I said, you know what? What's the average return? Average return on investment for real estate. First article that pops up was in Forbes. So according to Forbes, in the U.S. market, the median return on real estate is 8.6% annually, according to the S&P 500. Investment and strategies will affect the overall return, and the different types of properties attract different types of investors employing different strategies. So residential ones generally have an average return of about 10.6, commercial properties 9.5, and REITs perform at 11.8. So if an investor says, hey, Benji, I'm offering 21, and that sounds like it's twice the normal, you need to pause. You need to slow down. You need to ask yourself, what level of risk am I taking to get this 21%? What is the hidden risk that I'm not thinking of? And then who is this operator and how have they done it? Do they have a track record and a history of success? Are there other investors that I could talk to that have exited with them? See, I'm going to take the lower, more conservative return from an investor who made it through the great financial crisis of 2008, 9, and 10 than the new young guy or the new gal on the scene who's promising me 21%. I'd rather go for the history and the track record of success than betting on potential future performance. So this is happening. These syndications are blowing up right now. These funds are blowing up. And they're blowing up because rates went from an all-time low in the 3s to now they're in the 6s, 7s, and sometimes the 8s. So some of these deals didn't work, and they didn't build any buffer into them. They didn't create any cash flow as reserves. So what's happening is these investors are getting damaged. Now, in this exact example, it was an actual Ponzi scheme. But realize there are other investments that investors are getting harmed in right now too, because there was no guardrails put in place. And these are operators that didn't live through the last recession. So it's one of those things. Don't let your greed get the best of you. Don't let the fear of missing out and the promise of a 21%. I got called earlier today by a gentleman who's doing a fund. And he said, should we promise a higher return or a lower return? I said, number one, a pro forma never survives first contact. Just doesn't. It's just a spreadsheet. Number two, all of our pro formas, what we do is we take averages over time, and then we generally try to back them down a little bit. That way there's a little bit of cushion built in there. That way I'm over-promising and, excuse me, I said that wrong. That way I'm under-promising and over-delivering. That way there's some buffer in there. And then I said, we're going to promise a lower return and then just pay them a higher return to begin with. But anyone, going back to that 21%, who's now going to promise a big return right out the gate, in your mind, you need to go, wait a second, how are they doing that? And what level of risk am I inadvertently exposing me and my family to?
It's great advice to have that range that seems comfortable. Because on the flip side too, if you're getting less than 8%, especially if you can get, in the last couple of years, 7-8% with treasuries or whatever, that's also good. But especially on the other side, because of course, somebody's going to tell you that if they want your money, right? Yep. And if that is true that you can get it, then everybody would want to get it. So naturally, even if it was true, what it would do is naturally there's going to be other people that fall into it. Yeah. And when there's more competition, it gets volatile and it gets unstable. So having that range, I think, is great wisdom historically, because Ponzi schemes, scams,
yes,
con artists are not a new thing. Right? So like the trend leads to the 8 to 12%. Because right when things get going, guess what? There are people with good intentions that are professionals with experience that can yield you higher rates of return. But as that is happening, the con artists see and go like, oh, I could offer a little bit more. I could even leverage these professionals and what they're doing in a good way to make my argument stronger. Yeah. So I've never actually heard of that. And, I can speak from experience too. Yeah. There's some times where I know you have offered opportunities to me. Yeah. I'm like, I know these numbers could be better based off of I know is happening, but you almost in a way take this advice for yourself.
Oh,
right?
1,000%.
Not only for the investor, but even for yourself. It's so tempting. Benji, but by the way, on the side, I'm telling you, we could do way better than that. But you never do. You're always hey, this is the range that's realistic. And then the upside is the upside.
The upside
am
is
I
the
going to
upside.
complain about it?
Yeah.
But I'm also not going to complain if it hits within that more conservative range.
Bingo. So I would tell the people listening that you're going to be promised somewhere between a 5 to a 12%. That's generally what people get promised. And I'd say 6 and 8 all the time is very normal. When it starts to crest 10, you need to immediately start asking more questions. Because what's happening is they're putting you into a higher risk category in order to generate that higher return. And that's fine if you're okay with that level of risk. Just understand higher return equals higher risk. That's it. There's no way around it. There's no magic sauce. There's no magic pill. Higher return is a higher risk.
Steady Freddy is always the way to go, especially in real estate.
Yes.
Can't go wrong long term with those kind of numbers.
I heard it again the other day. It's the simple thing of real estate is a get rich slow game. Buy real estate and wait. That's it. Okay. Now there's going to be times when you go through a market cycle and you just hit it out of the park. That happens. But you want to look at what has that investor, what has that individual done over a decade or over 2 decades? Not what have they done in the last 3 years? Because in 3 years, you could just be in a specific market cycle.
The next topic is tell me the opposite of Jamie Dimon's thoughts. Where is the commercial real estate crisis possibly showing up?
So like we mentioned before, we like to look at both sides. We want to look at the bears. We want to look at the bulls. We want to look at the positives. We want to look at the negatives. I see this article. A Canadian pension fund dumps their stake in a office building in New York City for $1. And my spidey sense goes, whoa, what's happening there? So the largest Canadian pension fund took steps to limit its exposure to just office in general. And they're called the Canadian Pension Plan Investment Board. And what they did was they did 3 very large deals at massively discounted prices. They sold their interest in a pair of office towers in Vancouver, a business park in Southern California, and then they took this redevelopment project in Manhattan and they offloaded their stake to their other investment partner for $1. Now, the worry is holy cow, if this is the largest pension fund in Canada, and pension funds out of Canada are notorious for buying large chunks of commercial real estate, it's what they do. Is this setting the stage for additional turmoil and troubled waters essentially ahead? Okay. So they get contacted and they say, no, everything's fine. We're simply redeploying our cash. We're actively looking for...
$1? I'm confused here, you know?
They did get money out of the other ones, but they took losses.
Yeah, but so you're saying the $1 is attributed to the Manhattan, but
Yes.
the other ones, they got cash.
They got some cash, but they got cash discounted. So they got their cash back, but they got less of it.
Yeah.
Yeah, but for $1, that's definitely worth asking. What they're doing is they said, we're shifting our strategy. We're getting ready to redeploy our cash. Naturally, they don't comment on it. And they just say selling is an integral part of our process. When we exit an asset, we're there to maximize its value and we're able to redeploy into higher and better returns in other assets and sectors and markets, including office buildings. So they're saying when they did talk about it a little bit, everything's okay. The CPPIB has $436.9 billion in assets. It is one of the largest pools of capital in the world, and their stuff stretches from literally Asia to Stockholm to Vancouver and back into the United States. And it includes all these property types, but for some reason they've started moving away from office and they got rid of this one in New York very cheap. So I was like, okay, let's dig into this one of New York. So they own 29% stake in Manhattan's 360 Park Avenue. They sold it for $1 to their partners, Boston Properties, Inc., which also assumed their share of the debt. So not only did they get rid of it, they said, here's our project for $1. They got their other partner to assume their chunk of the debt that they were already liable for. So they're totally washing their hands. This is a redevelopment project in downtown Manhattan. Redevelopment means they're repurposing a building or they're going to tear it down and build something else in its place. Boston Properties said that they had already spent $71 million on the project, but severing its ties released them from additional $46 million. So CPPIB, $46 million back to the other partner. This kind of goes back into like, well, what's happening here in New York? And is there some underlying problems in commercial? So even though Jamie Dimon was telling us commercial's okay, there are still problems brewing in the background. Let's be very clear. If interest rates stay higher than we want, more pain will show up in 2 specific areas right now: banking and in commercial real estate. And the 2 of those are tied directly together. So if the Fed can't keep inflation under control and rates have to stay higher for longer, those 2 areas are in trouble: small banks, commercial real estate. Now, when I say in trouble, everyone immediately goes to 2008. This is not a 2008. This is not world ending. However, we know that China is also in trouble with their real estate sector. So that's putting pressure on the U.S. real estate sector. So the Fed is literally, they're flying the fighter jet at like Mach 1 down the canyon walls right now, just trying not to smash into a wall. They're speeding through, hoping they don't break anything else or blow up the fighter jet, aka the U.S. economy, in the process. But we're burning as fast as we can. Any thoughts from you before we move on to this last spot?
Oh, no, I'd say, I guess on a macro, who would have ever thought when we were starting to see lowering of rates, that rates would get bumped back up.
Yeah.
Obviously, that's because the economy and some of the data that's coming out. And what does Papa Powell always say, right? It's like it's all based off the data. We're data dependent.
Yeah.
So based off of this data, it's he already said it, highly likely that they're going to keep high interest rates. So more likely that this the banks and the commercial real estate problem will become a thing.
It's going to become more and more of a thing.
Yeah.
I don't know if the wildfire is going to burn out of control, though.
Yeah, for sure.
Okay, we have to watch it.
But like you even said, even if there is no wildfire, there's definitely opportunities.
There's currently already fires.
Yeah. Oh, yeah. Well, and where there's fires, there's opportunities.
When there's fires,
right?
there's opportunities.
Because like you said, in the case of a $1 pension fund sell, you could be that investor that comes in, not necessarily, I mean, like not everyone's going to get a whole freaking commercial real estate portfolio for $1. But the point is, what's in your local area that's burning up, that somebody wants to offload, right? When there's volatility, uncertainty, when there's doubt, there's people that don't want to deal with it anymore. Bingo. I think like even bringing it down to like the first time home buyer investor or like the local person that's just trying to like make a few bucks. If you're willing to put out the effort and solve a problem, right? Or take somebody else's problems off their portfolio and deal with it, that's where you can make money, no matter what market in. So that's what I'm hearing right now.
Bingo.
It's just not as fun to talk about because everybody wants the easy money solution, right? Like they want the lower interest rates. They want it to be what it was for a whole decade, and it might not be, which it hasn't been in the last couple of years.
Jennifer said it really well this last week in our sales meeting. Jennifer runs the RESG. She said, real estate right now is not a want to, it's a have to. So each one of these transactions is harder than normal. And I think that applies on both the residential side and on the commercial side. Mm-hmm. It's not a want to, because if it's a want to, rates are low, the economy's good, everything's rosy, and it's just working perfect. These are have to events. When they say, hey partner, take on 46 million, give me $1.
Yeah.
Okay, there's something else going on there when you do a move like that. You're not necessarily just repositioning for better capital and better returns. That's a big loss that pension fund just took.
By the way, the buck isn't even like an arbitrary number. It's just the number that's required probably by the state of New York to create like a transaction. Yeah. Because if they could, they would have done it for $0.
Yeah, exactly.
Like it was that bad, right? It wasn't even worth $1.
Hey, this is a really bad piece of junk. Take it.
I think that's a good clarification though, because when you read that, you just think, oh wow, somebody bought that for $1. Why wouldn't you, right? Like your biggest loss is $1. No, you're also inheriting the debt. Bingo. They're offloading the debt on top of it. So that's why you have to dig into it. I guess my big takeaway though, just for anybody, because this is my personal takeaway, the importance of doing your own homework and research.
Yes.
The importance of knowing what you're doing and knowing the market. Because when real estate gets difficult, and it's difficult for everybody, the person that's going to win the deals, win the negotiation, and win the profits is the one that knows the most. And you know the most not only by researching the most, but doing the most too. Like you said, what Jennifer mentioned, it's not just a need to do, it's a have to do.
Yeah.
You have to. If you want to be a professional and be an actual player in the game, you can't be like, oh, this is like a side hobby for me, I might get to it. You know what? I'll spend this much money. Worst case scenario, I make 6%. No, I mean, worst case scenario, you lose everything, right?
Bingo.
But best case scenario, you're the guy that is treating this like a profession, that is the pro. And guess what? You're going to make the money where other people lose money.
It's that age-old thing of the amateur versus the professional. The amateur shows up, plays the game when they want, doesn't know all the rules, doesn't exactly know how to play. The professional practices, watches game tape, has a coach, learns more about it. Kobe Bryant shows up before practice, last one to leave, is prepared, learns about it, and constantly rehashes it over and over again. And you see that also just even on the industry side right now. The people who are doing well in real estate are the professionals. Like if they're doing a bunch of business right now, they're the professionals. The ones who aren't, those are the amateurs. Okay, amateurs, guess what? Get out of my business. Like,
Boom.
make room. Let's go.
All right, last topic of today. And the question is there something going on here in the New York area? Because after Donald Trump's $454 million civil fraud verdict, Grant Cardone says he won't invest in NYC anymore. And now the largest Canadian pension fund that we just talked about sells office building for $1. What do you think?
I can't wait to see some comments on this video because regardless, people are going to get political and they're going to say something in the comments. So, New York judge hands Donald J. Trump a crushing defeat in his fraud case, finding the former president liable for conspiracy to manipulate his net worth and ordering him to pay a penalty of nearly $355 million plus interest, which could wipe out his entire stockpile of cash. So Trump's fraud penalty will exceed $450 million based on the interest it has started accruing. It accuses Trump and his associates of misstating valuations on financial statements for personal gain, which is made up of three separate penalties, one for $168 million, another one for $126.8 million, another one for $60 million. So, this is what's crazy. The interest alone on this judgment is $111,984 a day, almost $112,000 a day, according to New York Attorney General Letitia James. Then that's who brought the case against Trump.
It's not even a studio in New York a day.
Yeah. Whether he did this or didn't do this, personally to me is irrelevant. We're going to get into how this affects real estate, what this means for real estate, what this means for the New York area. New York Attorney General Letitia James sued Trump and his business associate, including his sons, for fraud in 2022, alleging they had fraudulently inflated the value of their assets in order to obtain more favorable business deals. So here's what is really interesting. The judge who presided over this case ignores the fact, like whether this is a crime or not, so allegedly, that this was, if there was a crime, that this was essentially a victimless crime because everyone was repaid. And then the bank said, yes, we would do business with Mr. Trump and his associates again. So I think Kevin O'Leary really said this best. He said, remember, there was no money lost. There's no victim here. So essentially just under a $500 million fine for a situation where no money was lost and the harmed party, supposedly the banks, were fully paid back, he said. We're wondering, does this make sense? Asking ourselves, how long will it take for the appellate courts to bring this down to a reasonable number? And I have no idea what that is. So what he's saying is, what he's talking about there is he's saying, New York, NYC, you're scaring investors. You're scaring capital markets. Judge, and this is my words, not his words. Judge, are you an appraiser? Are you a real estate professional? How do you know what valuations happen? Now, and also, isn't it the bank's interest to go do their own investigation, to then pay for their own independent financial analysis to figure out, is this property worth doing? And is Trump and his associates worth taking the risk on? What then Kevin O'Leary starts talking about is now he's very concerned about the next step of seizing assets. And he's made a reference to the effect of, like, this is starting to sound like Venezuela. Like, this is another country when we're going to just start taking assets from Americans. Like, this should sound a little crazy. The reporter's sitting there just trying to cut him off, and he's just charging forward. Capital comes to America because of the stability of our justice system, O'Leary said. This is not stable in terms of many people's eyes, domestically and internationally, by seizing assets like it happens in Venezuela. It doesn't happen in New York, so this is a little scary. So what he says is going to happen is you're going to start to see an exodus of capital leaving New York Doesn't matter if you're a Republican. Doesn't matter if you're a Democrat. Let's play this through. You go make an investment to build a building or to buy a multifamily. And then later on, a judge decides they don't like you. They decide that the bank doesn't know what they're doing. And they decide, even though all loans were paid back, that they're going to come after you, Benji, and sue you for your money you put there. Are you likely to put money in that state?
No. Or I'm definitely going to be more hesitant.
I'm not going to put $1 there.
Yeah, just go somewhere else where you're not going to have any issues.
So then Grant Cardone comes out, jumps on the bandwagon, and he says, if this ruling and that penalty do not get overturned, it could become a precedent that means all borrowers everywhere are at the risk of the same thing happen to them. And you have to think about how our judicial system works. What happens is a ruling happens, and that creates case law. When that case law happens, there's now precedent for other cases to follow that. So he takes it to the nth degree and says, well, if it happened in New York, it could start to happen everywhere. Might be a little much, but it's a good soundbite. And then he goes on to say that prices of properties will continue to fall in New York City as more and more institutions, investors, and pension funds refuse to invest there. Investors and those seeking on behalf of the others, they have a fiduciary responsibility to invest in markets where you assume the future values are going up with some measure of confidence. He announced this on X, aka Twitter. Dear Cardone Capital Team, immediately discontinue all underwriting of New York City real estate, he tweeted. The risk outweighs the opportunities at this time. Recent political decisions will continue to deteriorate prices and benefit states that don't have these challenges. Then, we already talked about it. We had that pension fund. That article just came out. That was just released. I'm like, oh my goodness, is everyone leaving New York? So I had to dig into it, and I found out that pension fund actually sold that office building in Manhattan for $1 to the other partner to take on $46 million worth of debt. That happened at the latter part of 2023. So that was happening before. But there's already problems happening in commercial real estate in New York City. There's already problems happening in these very hardcore blue states with their commercial real estate because of the regulations being put on them. In our area locally, this was said to me 2 weeks ago. Someone said, man, did you see how much of Amazon moved out of downtown Seattle over to Bellevue? And I said, yeah, Bellevue doesn't have a head tax like downtown Seattle has a head tax. So when corporations are really big and they have a lot of money, they can just shutter their workforce down and just move over to that city is not even 15 minutes. It's like 10 minutes away across a bridge. So they just close down shop there and move right over here. What they're saying here and what concerns me and what investors need to pay attention to is not Republican, Democrat. That's a whole war of words in itself. Is the fact that a bank did its due diligence and a court said the bank was wrong and there was no loss to the bank and now someone's being sued. That scares me. That should scare every investor. And you need to put your money in places where it's going to be safe and be allowed to grow and not be inhibited by the courts or outside regulation who may or may not be on a potential witch hunt.
There's actually three things that I take away from this little article or this topic you're bringing up. Number one, just from a rational investor standpoint, if you see that kind of stuff happening, whether it's right or wrong, you're already going to be wary because, hey, if it's happening to Trump, regardless of how you feel about him, it could happen to other people. They're almost setting a precedent that the market can't decide for themselves what they want to pay and what somebody else asked to get paid, you know, right? That as old as time, people have been doing that, right? You didn't need a judge to tell you that or like a court to decide it. You just did it between two people. And guess what? When the price was too high, you just said no. And
you just didn't buy it.
And guess what? The market by itself balances itself out. And so now you're saying you can go back in time and be like, hey, that was overpaid. You're a scam artist. When literally probably, and this is what's probably making a lot of people fearful. I'm not saying you specifically because you're not in the New York area. They're like, did I say a price that was way too high? Could I have to pay a fee? So that's number one. Number two, the PR problem of this.
Yes.
The PR problem is this: whether it's right or wrong, whether it's truthful or it's not the truth, people are reading it on articles, they're hearing about in the news. Kevin O'Leary is a huge name in the financial world, in the media world, and he's saying this, right? Grant Cardone, huge on social media, making these public posts. So it is gotten away from New York.
Yes.
And the PR problem is beyond them. Now you have to hope and wait that this all kind of dies down. But right now, people are reading this on their phones, and now they're going to make decisions. So it's easy enough to be like Grant Cardone's a good example. Not doing business in New York. Let's just go over here to Georgia. Maybe not Georgia, maybe like Arkansas. I don't know, right? Wherever there is more friendly. The third thing is this, though. There's an opportunity.
There's always one.
The opportunity, and actually I was just walking around downtown Seattle, and what do I see? A ton of boarded up buildings.
Yep.
But guess what? 10 years from now, when we forget of all these bad policies that created all these really bad neighborhoods, we're going to wish we put in an offer. So I'm not saying New York City right now is a place you want to buy, because actually, guess what? The exodus is just starting.
Yeah, you
so
got to wait.
You got to wait a little bit, but pay attention to it.
Bingo.
So I'm telling you, me personally, I'm paying attention to downtown Seattle, because right now nobody wants to be there. But guess what? Those prices are going to start getting driven down. Now, residential real estate, totally different ballgame, right? Houses, whether it's apartment, condos, or new developments, totally different story. But commercial real estate in these downtown areas, because it's highly unlikely that they're going to be ghost towns forever. In fact, guess what? It's a normal cycle.
It's a cycle.
So, I look at it and I'm like, okay, yeah, I'm not going to buy in that area right now, but man, keep your eye open, because there might be some deals. Because when you buy, when it's a deal, when like nobody else wants it, 10 years from now, when it go through, whatever, gentrification or, redevelopment, or the policies change and they pump money into it and it's nice, man, you're going to look like a genius.
And that's what I always want our investors to hear, is that we're always trying to look at both sides of the story. And then we're trying to look at, how do I protect my assets today, and then turn that same coin, just flip it over and go on the other side of that coin. How do I grow my asset base, and what's the opportunity being created by this problem? There are always two sides to that. And you should be constantly hearing that message if you're one of our regular listeners. Every problem is also an opportunity. I love it. Don't know if I'm ready to go to Seattle, but I still love it.
I want to bring back Warren Buffett, and he knows all about timing and
Bingo.
why he's dropping billions of dollars, because he kept paying attention to it. That's all he does. He's famous for literally just reading stuff and looking at numbers all day long. Like, his days are pretty boring. That's all he's doing. He's not like on his jet flying everywhere all the time. He's actually doing most of his work at his desk, reading newspapers, reading performas and business, I don't know what kind of stuff he's looking at. And then he's just waiting for the right time to make the right decision. And then it pays off, not necessarily a year from now. You do hear those type of stories, but usually a decade after he makes that thing. And that's what's exciting about real estate, because when you make the right decision at the right time, all you have to do is wait.
Yeah.
You just wait, And I mean,
And there's so much data right now pointing towards it's go time. And we've been talking about this. Like, there's some great opportunities. I get it, rates are high, and I get it, inventory's low, but there's great opportunities, and some of them you have to just go find. This popped up at an investor class that I did with one of our lenders. The investor says, there are not enough deals. In my mind, when I hear there are not enough deals, I actually hear I'm not willing to do enough work to find enough opportunities and do enough research in order for me to be able to identify a deal. There's never a lack of deals. There's a lack of work, understanding the market, knowing the data, and taking the action. Not a lack of deals. Opportunity is always there. You just have to be able to see it.